Hey, dear friends, in our last session we discussed about duty drawback. Today we will delve into neutralization of goods and service tax. Dear friends, this has been a historic reform in our country. Our country deliberated for more than 2 decades how to harmonize various taxes. In fact, our is a country which is the most taxed country in the world at one point of time. So our government took a historic decisions, and I must congratulate to all the associated stakeholders for having reform our tax regime. Dear friends, goods and service tax come into force on 1st July 2017, and with these historic reforms, 15 taxes, 8 central taxes, 7 state taxes had been clubbed into one regimes, which is goods and service tax, which has three components. In the first component is central taxes, the taxes which go to the kitty of central government. Second part is state taxes, state GST, SGST, where the certain percentage of half the percentage of the tax that we pay go to state government. And where there is an interim tax, the tax neither it goes to central government nor it goes to what we call as state government. It is interim tax, it is not a final tax, but the goods must be taxed in the value chain, and subsequently it stand neutralized. In that case, it is known as IGST, Integrated Goods and Service Tax. Dear friends, when we manufacture any item, we have to source certain component. And when we source certain component, let me take an example. There is an automobile manufacturer. When they manufacture car, they have to source certain component from outside. So reasons are very simple. It's economical. There are certain very specialized goods cannot be manufactured within the factory. And when we source them, we have to pay a tax called goods and service tax. A part of that may go as CGST, a part of that may go as SGST. We claim input credit of that. We know the documentation. When any manufacturer or any supplier, when they supply the goods, they have to file a return. The dates are mandated in the GST legislation, where it is clearly mentioned that by in the next month, by 15th, GSTR1, that is the form which has been mandated for outward supply of goods to any party, the tax must be paid. In similar fashion, dear friends, the party which procure these goods claim the input credit. Earlier there was a form called GSTR2, but with an increasing introduction of what we call information technology, now only a reconciled document known as GSTR3B has been mandated. So understanding about this document is very, very important. What are the output duties? What are the forms to be filled? What is the input duty? And what is the forms to be complied? So we have discussed two forms, GSTR1, GSTR2. Now, when we manufacture for export, dear friends, we discussed in last session that goods are exported, taxes are not. There are three people in India, or there are three parties in India who never pay taxes, and I call them as lovely son of government of India. These are number one, Jai Jawan. Jawans are not supposed to pay taxes, dear friends. For the canteen, the goods they buy, they are not supposed to pay taxes. Similar fashion, Jai Kisan. Our Kisan pay a lot of taxes, but those taxes are usually neutralized through MSP, minimum support price. Similar fashion, any tax paid by exporter must be refunded back. So I call it Jai Jawan, Jai Kisan, Jai Exporter. And today we will discuss Jai Exporter with a lot of enthusiasm and delve into issues how these taxes are neutralized through GST RFD1 and GST RFD11. I will discuss both input taxes and output taxes, first delving into output tax. So let me explain you how the goods and service tax has been a historic reforms. They have offered, in fact, the enormous benefits to India's trade community. And one of the major benefits that is discussed and deliberated in the market is that the goods and service tax has helped to eliminate the cascading effects of the taxes. When I say cascading effect, it means that earlier taxes, they were tax upon tax. So there is a fundamental golden rule for any country or for any tax policy maker or any taxpayer. Goods are taxed, taxes are not. There should not be tax upon tax. In our previous lectures, we have discussed that goods are exported, taxes are not. But here the fundamental golden rule is goods are taxed, taxes are not. One of the major problems with the previous tax regime was that there was a tax upon tax. Let me take an example. There is a manufacturer based in state of Gujarat. He manufactures certain electronics items. To manufacture that item, he procures certain components from 3 states, one from Maharashtra, from Tamil Nadu, and from Punjab. So when the goods come from other states, he procures them under CST, pay 2% of duty. Against Form C, goods comes there for which no input duty he can claim. Number 1. Number 2, he source certain items locally on which he pay hypothetically VAT, which is at the rate of 4% or 5% or 8% and 12%. Hypothetically pay 8%, for which he can claim the input credit, which can be set off in case the sale is likely to happen in the domestic market. But that is not the case with this form. Sale may happen across the country. Dear friends, then when the goods are manufactured, if turnover was more than 1.5 crore rupee, there was a tax called central excise. So he pays certain taxes on sourcing of goods when they are manufactured and created into one final product. He pay a tax upon tax. When he source those goods, he pay VAT. When he finally manufacture them, he pay a tax to central government known as central excise tax. Then there was a service tax. There was a custom duty. This was 8 central taxes and 7 state taxes in the value chain. And this cascading effect used to, what we say, has a multiplier effect on increasing the cost of production, thus making product what we call unattractive in the market, uncompetitive in the international market, and have inflationary pressures in the system. It leads to a lot of other problems, problem of tax avoidance, problem of embezzlement of taxes, problem of what we call as of making relationship with the corrupt officials and not to pay tax. Those are the issues which has cropped up in our systems. And there are several surveys and there are several reports, there are several investigations which proved that there is a huge tax avoidance by the parties concerned. And as a result, the nation lose important revenue which otherwise can be used in order to meet the developmental requirement of the country. Number 2, to reduce the existing tax rate, because in India tax rates are very high. As a result, our, as a reputation as an international attractive destination for manufacturing has been badly impacted. So that has been the major benefit of goods and service tax. Then tax will comparatively be lower as the tax base widen. Yes, we just discussed. As your tax base widen, there are more number of people who are paying taxes. I was reading a book which say collecting a tax is like collecting a honey. Like the honeybee collect the nectar from the flower without affecting the beauty of the flower. She collect the nectar and convert into honey. Similar fashion, a tax agency or a revenue agency must plan taxation in a fashion that it should collect the tax without hurting the economic interest of the parties concerned or his motivation to do more or to work more. Seamless flow of input credit in the GST, because one tax, one system, one nation. So one nation means one kind of form, so it becomes easy to claim input credit, which was not the case as we have discussed in the first example. Prices of the goods become, sometimes they become high, sometimes they become low. Reason being, some states used to reduce their tax rate, as a result the prices used to fall. Sometimes some states used to increase. So this has become this is no more a pan-India problem. One system, one country, one tax rate, and one nation. That's all. Efficient supply chain management. It helps firms to properly plan their warehouses in the areas where there can be distribution efficiencies. Earlier, warehouses were located in the places where there were tax benefits. Now it is no more a tax benefit, it is the distribution efficiency where it helped me to cut my logistic cost. I would like to base my warehouses. So efficient supply chain management has come with goods and service tax. Promote shift from unorganized sector to organized sector. There are a lot of small players who used to come with the new firms who can operate below 1.5 crore in terms of manufacturing. That tendency is gone. The limit is too low, it is just 20 lakhs. So anyhow, there is a lot of, new firms which has come into tax regimes. And a lot of surveys depict that the number of people getting GST registrations has increased many fold after this new regime has come into form. So GST registration is very easy. In case we want to neutralize, we must be having GST registration, only then we are entitled to GST refund. Dear friends, GST registrations, majority of the firms must be having. Those which does not have, they can follow these simple steps and get themselves registered. Once you have a GST registrations, dear friends, then it become important for you people to neutralize the duties, and that is the subject that we have to discuss, and that is the subject which is very important for us people to deliberate today. Dear friends, neutralization of taxes is done on two stages. First, let us understand output stage. In case of output stage, Government of India has made it very clear under Section 90, under Rule 96, subsection A, that the output tax will not be collected from the parties concerned in case they file either bond or bank guarantee or legal undertaking. So that has been defined under GST RFD 11. And let us check how does this forms looks like and what purpose it serves, and make a case. The fundamental rule that every exporter should keep in mind, and my brothers and sisters all across the country should keep in mind, that only goods are exported. Taxes, whether they are input taxes, if they are in the form of custom duty, will be settled through duty drawback. We have already discussed what is duty drawback. If they're in the form of, for example, called GST, even they stand neutralized. Output taxes you are not supposed to pay. If you pay, you can claim them back. So you must have a GST registration to be eligible to claim that. And you must not forget my final words. And my final words are Jai Jawan, Jai Kisan and Jai Exporter. And for a country of our size, if it want to grow in international market and it want to become a developed country, we must focus on these three broad areas: the defense of India, the agriculture of India, and the export of India. With these words, dear friends, I conclude these subjects, and now I proceed towards summary of these subjects. So before I summarize, let us understand in detail certain golden rules. Number one, exporter, even if they pay tax, must be refunded back. Number two, we must be smart enough to understand the regulatory framework and the form involved to claim that back. And number three, let us relish that exporter is lovely son and lovely daughter of Government of India. They are not supposed to pay taxes. So relish these words and enjoy your venture of export and import. I wish to all of you very warm, welcome to the field of export import management, and look forward to see you to grow and to show the success in the area of foreign trade. Do you have any questions? Please don't hesitate to write us back at the emails which are provided in the PPT. The concerned faculty you must contact. Thank you very much.